My name is Arturo Gonzalez, and I wanted to welcome you to the second day of the Community Development Research Conference. I know yesterday's conference was really exciting. There were a lot of interesting presenters. I know Chair Yellen was here. It'd be really hard to top her, top the other speakers, presenters, amazing research that occurred at the concurrent sessions. I really enjoyed it. I think it's really fascinating. We wanted to have provoking conversation, and I think we've met that challenge. While yesterday might be hard to top, I think today we're going to do so, if not succeed in many ways. Today's conference will consist of additional research. First, we'll have a discussion of plenary session number 3, which will focus on workforce development and the development of youth and children and their impact that workforce development has later in life. We'll also look at the impact that community institutions and assets have on youth development. Jeffrey Canada will give the afternoon's keynote and share his experiences with the Harlem Children's Zone. But first, I would like to hand things off to Alicia Williams, who will introduce Charles Evans, who is the president of the Federal Reserve Bank of Chicago, who will give some pre-recorded remarks. Alicia?
Good morning, everyone. I'm happy to be here in wonderful Washington, D.C. I guess this is cherry blossoms season. I haven't had a chance to get out, so I haven't seen anything yet. But let me extend my welcome to you as well. But first, before I start, I do want to take a few minutes to commend my colleagues at the Federal Reserve Board, as well as the Federal Reserve Bank of Minneapolis, for putting together really an engaging and thoughtful conference. I also want to thank the speakers that shared their perspectives and their research. So I think we ought to give them a round of applause. For those of you who may not know, the Chicago Fed will be working with the board in partnership in 2019. So that's sort of why I am up here this morning. And we're definitely looking forward to doing that. Some of you, I don't know if you were around when the Chicago Fed partnered with the board in 2003. That was actually the third conference that the Community Development Function conducted. And yes, I was here then, and I was here at the first one too in 1999. So I've had a long history with working with the board on a number of fronts and my colleagues as it relates to this conference. So the next thing I would definitely like to say that as I reflect a little bit is that this conference has really evolved over the years. I mean, not only in its content that we've delivered, but I mean, I've seen it go from a ton of paper to a disc to an app. I mean, that's remarkable, is it not? So as you heard earlier, President Evans had a commitment, and he definitely sends his regrets that he can't be here today. But he will be providing prepared remarks. So you will hear his message in that format. Also, I've worked with Charlie for many years, not only in his capacity as president of the Federal Reserve Bank of Chicago, but I was also one of his direct reports when he headed up the Economic Research Department, because that's where the Community Development Function resides. So as a result, I could really speak directly and firsthand to his commitment to the work that the Community Development Function does. Charlie has also accompanied me and my staff on a number of community development site visits because he likes to hear things firsthand, and we sure made sure he had that opportunity. And he has been very engaged in those settings and has taken back a lot of information as, you know, for his own use and thought process. So Charlie has been president of the Federal Reserve Bank for almost 10 years. but his career with the bank has been extensive. Before becoming president in September of 2007, Charlie served as Director of Research and Senior Vice President, supervising the bank's research on monetary policy, banking, financial markets, and regional economic conditions. Prior to that, he was a vice president and senior economist with responsibility for the Microeconomics Research Group. His personal research, which has been published extensively, focused on measuring the effects of monetary policy on U.S. economic activity, inflation, and financial market prices. Charlie is also active in Chicago's civic community. A few of his commitments include serving as a trustee at Rush University Medical Center, a director of the Chicago Council on Global Affairs, and a member of the Economic Club of Chicago's Board of Directors. Charlie received a bachelor's degree in economics from the University of Virginia and a doctorate in economics from Carnegie Mellon University in Pittsburgh. So if we're ready, if we could play the tape. Thank you.
Thank you for the kind introduction, Alicia. And thanks to the organizers at the Board of Governors and the Minneapolis Fed for inviting me to be part of this event. I regret that I can't attend today, but I'm grateful for the opportunity to comment on the important issues raised at this conference. The Fed's mission is to foster the stability, integrity, and efficiency of the nation's monetary, financial, and payment systems so as to promote optimal macroeconomic performance. Ideally, a vibrant national economy translates to prosperity in all of our communities. Unfortunately, that ideal has not always been universally realized. For a variety of reasons, including major transformations in our manufacturing industries, some of our nation's communities have faced difficult obstacles to achieving the kind of economic success that the American public and policymakers expect. When communities struggle, the consequences can be long-lasting. Recent academic studies by Raj Chetty, Nathaniel Hindren, and others are able to confirm what earlier work had hinted at, but didn't always have the statistical power to precisely describe. Where you grow up or currently reside matters a great deal for academic performance, economic mobility, and health. This conference has highlighted the harmful effects of growing up in neighborhoods that suffer from a scarcity of basic needs, such as quality schools, fresh food, and child care facilities, to name just a few. Art Rolnick, the former research director at the Minneapolis Fed, and his colleagues proposed substantial investment in early childhood education programs many years ago as one very high return avenue to fighting persistent poverty. We should be particularly interested in these research questions because it is now well established that children growing up in the U.S. experience less intergenerational economic mobility and less equality of opportunity than children in most other advanced economies. But has this always been the case? Or has the American economy or society changed in ways that has made it even harder for children to move up than in the past? From the end of World War II to the early 1970s, the U.S. experienced what is sometimes referred to as a golden age, where economic growth was rapid and salaries grew throughout the income spectrum. Starting around 1980, however, there was a sharp rise in income inequality, the causes of which economists are still trying to understand. One simple question we ought to ask is this: did the shift toward greater income inequality beginning around 1980 coincide with a decline in economic mobility? A series of papers from the Chicago Fed over the past decade suggests that intergenerational mobility did in fact start to decline precisely around this time. For example, a recently released working paper by Jonathan Davis and Bosch Mazumder documented a marked decline in mobility between two sets of cohorts, those born between 1942 and 1953, and those born between 1957 and 1964. The first group entered the workforce in the 1960s and 70s, well before inequality rose, while the second group joined the workforce largely after the big rise in inequality. Davis and Mazumder show that the magnitude of the decline in mobility is striking and is the equivalent of moving from the top quintile of economically mobile U.S. cities to the bottom quintile. Since upward mobility may be particularly challenging for residents of low-income communities, it is imperative that we better understand what leads some communities to thrive, and just as important, what factors inhibit other communities from achieving success. Moreover, we need to do what we can to raise awareness of conditions and places in need of reinvestment and assistance. These objectives have made up the core mission of the Federal Reserve's community development departments for decades. The Fed's community development function was created shortly after the passage of the Community Reinvestment Act, which marks its 40th anniversary on October 12th of this year. The CRA was one of a handful of laws designed to ensure credit would flow to places where banks typically did not lend, and was a reaction to policy decisions dating back to the New Deal. One of the most infamous of these policies, based on 1930s era redlining maps, prevented banks from issuing mortgages to minority and some immigrant households or for older construction. New research by economists at the Chicago Fed is revealing the fingerprints of redlining practices from about 80 years ago on the characteristics of communities even today. While the worst of these lending practices have been addressed by CRA and other legislative and private actions, the CRA continues to be an important tool in addressing more subtle behaviors and policies and in encouraging scaled and coordinated revitalization. The Fed's community development function works in various ways to support and promote this work, to document innovative lending and development strategies, and to improve conditions in marginalized communities. This morning's plenary session will focus on skill development and workforce preparedness. It's encouraging that lending and investment in workforce development and job creation, with special emphasis on innovation in these areas, is now addressed directly in CRA guidance. It's also promising that CRA guidance encourages lending to groups that support and advise small businesses in recognition of the fact that entrepreneurs are the principal source of new jobs in low-income communities. There's a great deal of work going on at the Fed's community development areas to provide technical assistance and interpretation to financial institutions on these fronts, both in one-on-one meetings and larger informational convenings. The Fed's community development staff also works to ascertain the challenges to improving economic mobility through qualitative information gathering. A Fed publication titled "A Perspective from Main Street: Long-Term Unemployment and Workforce Development" was derived from a multi-year series of meetings and information sessions that collected the views of employers, local government, trade associations, educators, and others. Among the report's findings are that workforce development systems are not well coordinated locally, regionally, or nationally. Secondary education is essentially disconnected from the labor market, and the record of community colleges in meeting the technical skill needs of employers is mixed. In particular, manufacturers cited a dearth of skilled workers. In short, the evidence we have leaves considerable room for policy improvements to better harmonize diverse efforts and resources aimed at, ultimately, bringing about a better prepared and educated workforce. The stakes for our future could scarcely be higher. I once again want to recognize the organizers at the board and Minneapolis Fed, and look forward to organizing and hosting the 11th biannual conference in 2019 with the Board of Governors.